In the summer of 2000, Enron Corporation was the seventh largest company in the United States. Its stock was trading above $90. Fortune magazine had named it America's most innovative company 6 years in a row. Its headquarters in Houston, Texas, stood like a monument to everything American capitalism promised: ambition, growth, and an endless future. 16 months later, the stock was worth 26 cents. Not $26, 26 cents. $74 billion in shareholder value had evaporated. 20,000 employees had lost their jobs. Retirement accounts that workers had spent decades building were wiped to zero overnight. And the men who ran the company, the men who stood at podiums and told investors that everything was fine, right up until the end, walked away with hundreds of millions of dollars while their employees stood in line at unemployment offices. This is the story of Enron. It is not a story about bad luck or market forces or a company that simply couldn't compete. It is a story about lies, systematic, premeditated, industrial-scale lies, told at the highest levels of American corporate power. And it is a story about how long those lies can survive when everyone around them wants to believe. Kenneth Lay founded Enron in 1985 by merging two natural gas pipeline companies, Houston Natural Gas and Internorth. The combined entity was unremarkable at first. A traditional energy company moving gas through pipes, charging fees, earning steady returns. But Lay had a different vision. He believed that energy could be traded like stocks and bonds, bought and sold on open markets, packaged into complex financial instruments, priced in real time. He wanted to turn a pipeline company into a trading powerhouse. And in the deregulated energy markets of the 1980s and 1990s, that idea was not just viable, it was explosive. The man Lay hired to make it happen was Jeffrey Skilling, a Harvard MBA and McKinsey consultant who wore his intellectual arrogance like a badge. Skilling joined Enron in 1990 and immediately pushed for the adoption of a controversial accounting method called mark-to-market. Under this approach, Enron could book the estimated future profits of a long-term contract the moment it was signed, not when the money actually arrived, but the instant the ink dried on the deal. The SEC approved the method in 1992. What followed was the accounting equivalent of being allowed to spend money you haven't earned yet, and then pretend you already have it in the bank. For a while, it worked spectacularly. Enron's reported revenues grew from $13.3 billion in 1996 to $100 billion in 2000. It expanded into broadband, water utilities, weather derivatives, and dozens of other markets. The stock price climbed, the awards accumulated, the press coverage was reverential. Skilling became CEO in February 2001. Ken Lay remained chairman. The company looked from the outside like the future of American business. From the inside, it was something else entirely. The problem with mark-to-market accounting is simple. It only works if your projections are honest. And at Enron, the projections had become fiction. Deals that were losing money were being reported as profitable. Businesses that had never generated a single dollar of actual cash were showing up on the books as thriving assets. The broadband division, which Enron valued at $30 billion, had almost no real revenue. The international assets, including a disastrous $3 billion power plant investment in India, were hemorrhaging cash. And behind all of it, the real debts were being hidden in a maze of off-balance sheet entities, with names that would later become infamous in financial history. Andrew Fastow was Enron's chief financial officer, a 39-year-old financial wizard who had designed an architecture of deception so elaborate that even most of Enron's own executives didn't fully understand it. He created hundreds of special-purpose entities, shell companies with names like LJM Cayman, Raptor, and Chuco, that existed for one primary purpose: to absorb Enron's losses and debts and keep them off the company's official financial statements. What made Fastow's system particularly grotesque was that he personally profited from it. He was running entities that were supposedly independent of Enron, third-party companies managing risk, while simultaneously serving as their general partner and collecting fees. He made at least $30 million from these arrangements while officially employed as Enron's CFO. The man hired to protect shareholders was looting the company through structures too complex for most people to understand and too profitable for those who understood them to stop. Arthur Andersen, one of the 5 largest accounting firms in the world, audited Enron's books every year. They signed off on every statement. They approved the methodology. And they were paid $52 million in fees by Enron in 2000 alone. $25 million for auditing, $27 million for consulting. When you are being paid $52 million a year by the company you are supposed to independently evaluate, the word independent starts to lose its meaning. The cracks began showing in 2001. In March, a reporter at Fortune magazine named Bethany McLean published an article asking a question that should have been obvious. Is Enron overpriced? She noted that Enron's financial statements were nearly impossible to understand and that nobody seemed able to explain exactly how the company made its money. Skilling called her unethical for asking. Enron's investor relations team flew to New York to pressure her editor. The article was buried. The stock kept climbing. In August 2001, Skilling resigned as CEO, abruptly, unexpectedly, after only 6 months in the role. He cited personal reasons. Ken Lay returned to take the helm, but the timing was striking and Wall Street noticed. The stock fell on the news. What nobody outside Enron knew yet was that on August 15th, one day after Skilling resigned, a vice president named Sherron Watkins sent a letter directly to Ken Lay. It was 7 pages long. It told him that Enron would implode in a wave of accounting scandals. It named the specific partnerships. It warned that the company's accounting was improper and potentially fraudulent. It begged him to investigate. Lay's response was to ask Enron's own lawyers, the same law firm that had helped design some of the accounting structures Watkins was warning about, to review the situation. The lawyers concluded everything was fine. Lay did not go to the board. He did not call regulators. He did not change course. Instead, Lay appeared at an all-hands meeting with Enron employees and told them the company was in great shape. He encouraged them to buy more stock. At the same time, he was quietly selling his own shares, offloading $70 million worth of Enron stock between 2000 and 2001, while publicly insisting the company's best days were ahead. October 2001. The walls came down. On October 16th, Enron announced a $618 million third-quarter loss, the first public acknowledgement that something had gone badly wrong. The company also disclosed a $1.2 billion reduction in shareholder equity tied to the unwinding of one of Fastow's partnerships. The SEC opened an inquiry. The stock dropped from $33 to $20 in days. On October 24th, Fastow was placed on leave. On November 8th, Enron admitted it had overstated its earnings by $586 million going back to 1997. Not a small accounting error, not a rounding mistake. $586 million that had never existed, reported as real profit, used to justify a stock price that had made insiders fabulously wealthy, while ordinary investors bought shares in a company that was already dying. The Dynegy Corporation attempted a last-minute acquisition that might have saved Enron's creditors. It fell apart when the full scale of the hidden debt became clear. There was too much to salvage. On December 2nd, 2001, Enron filed for Chapter 11 bankruptcy. At the time, it was the largest corporate bankruptcy in American history. $63.4 billion in assets. Gone. The stock that had traded at $90.75 in August 2000 closed at 26 cents on the day of the filing. What happened to the people who worked there is the part of this story that the financial press sometimes glosses over in favor of the legal drama. But it is the part that actually matters. Enron had 20,000 employees. Most of them had no idea what was happening inside the executive suites. About 95% of the workforce had nothing to do with the fraud. They were engineers, accountants, traders, administrators who showed up every day and did their jobs honestly. Their retirement plans were structured heavily in Enron stock. This was encouraged, incentivized, celebrated. Employees who put their 401k savings into company stock were seen as loyal, committed, aligned with the company's success. When the stock collapsed, those savings collapsed with it. Workers who had spent 20 and 30 years building retirement accounts lost $800,000, $900,000. In some cases, everything. The people who had believed the most, who had been the most loyal, were punished. The most Enron's collapse also destroyed Arthur Andersen. The firm had shredded documents related to its Enron audit after learning the SEC was investigating. In June 2002, Andersen was convicted of obstruction of justice. The firm surrendered its accounting license. It had employed 85,000 people worldwide. Within months, it had ceased to exist. The legal reckoning took years. Andrew Fastow pleaded guilty in January 2004 to 2 counts of conspiracy. He agreed to cooperate with prosecutors, surrender $23.8 million, and serve 6 years in federal prison. His cooperation became the foundation of the government's case against the men above him. Jeffrey Skilling was indicted in 2004. His trial began in January 2006 alongside Ken Lay. For 4 months, a federal jury in Houston heard testimony about mark-to-market fraud, secret partnerships, insider trading, and a corporate culture in which anyone who raised concerns was marginalized or fired. On May 25, 2006, the jury found both men guilty. Ken Lay was convicted on all 6 counts against him, fraud and conspiracy. Jeffrey Skilling was convicted on 19 of 28 counts, including conspiracy, 12 counts of securities fraud, insider trading, and making false statements to auditors. Lay never served a day in prison. On July 5, 2006, 6 weeks after his conviction and 3 months before his sentencing, he died of a heart attack in Colorado. He was 64 years old. Because he died before his appeal was resolved, his conviction was vacated under a legal doctrine called abatement. Legally speaking, Ken Lay died a man who was never found guilty of anything. Skilling was sentenced to 24 years in federal prison and ordered to forfeit $45 million. After years of appeals and a resentencing, he was released in 2019 after serving 12 years. He is free today. In total, federal prosecutors secured more than 30 criminal convictions related to the Enron scandal and seized $164 million in assets. $90 million was distributed to victims. Against total losses that exceeded $74 billion, those numbers are almost too small to mention. The Enron collapse did not just destroy a company. It rewrote the rules. In July 2002, Congress passed the Sarbanes-Oxley Act, the most sweeping reform of American corporate governance since the Securities Exchange Act of 1934. CIOs and CFOs were required to personally certify the accuracy of their financial statements. New criminal penalties were created for executives who signed off on false filings. Audit firms were prohibited from providing certain consulting services to companies they audited. An independent oversight board was created for the accounting profession. Sarbanes-Oxley exists because of what happened at Enron. Every major public company in America today operates under rules that were written in direct response to what Ken Lay, Jeffrey Skilling, and Andrew Fastow built in Houston. There is a specific detail from the final days of Enron that stays with you. In late October and November of 2001, as the company was visibly unraveling, as the stock was falling and the SEC was asking questions and the press was circling, Ken Lay was personally calling members of the Bush administration. He called Treasury Secretary Paul O'Neill. He called Commerce Secretary Donald Evans. He called Alan Greenspan at the Federal Reserve. He was asking for help, not regulatory relief, not a bailout exactly. He was asking whether anyone in Washington could do something to stop what was coming. No one did. What is remarkable is not that they declined. It is that he asked, that even in those final weeks, with full knowledge of what his company actually was, With the memos and the partnerships and the shredded documents and the $586 million of phantom earnings, he believed there might still be a phone call that could fix it. That is the psychology of Enron in a single moment. Not a company that made mistakes and tried to correct them. A company whose leaders believed, until the very end, that the story they were telling could somehow become true if they kept telling it loudly enough. That belief was worth, at its peak, $70 billion in market capitalization, and it was worth, at the end, 26 cents. The auditors signed, the board approved, the regulators missed it, the press celebrated it, the employees trusted it, and 20,000 people paid for it with their careers, their savings, and their futures. The name Enron is still used today in business schools as shorthand for a particular kind of failure, not incompetence, but the deliberate construction of a reality that exists only as long as everyone agrees not to look too closely. When someone finally looked, $74 billion disappeared in 16 months. The only thing faster than the collapse was the speed at which the people who built it found ways to survive it.